All right, today we're going to dig into a trading strategy that comes with a really bold claim. What if simplicity is the real secret to making consistent profits, no matter how new you are to this? Let's find out if it actually holds up. Okay, I see that, and I know exactly what you're thinking. A promise like that, it just sounds way too good to be true, right? But here's the argument. Maybe, just maybe, most traders fail because they make things way too complicated. This strategy is all about cutting through that noise. And of course, just a quick but super important note. This is all for informational purposes. It's not financial advice. And you gotta remember, all trading involves risk. So, this strategy is called the manipulation theory. And its promise is, well, it's pretty huge. It says you don't need years of grinding or some super complex system to get ahead. The whole idea is to just focus on one simple, repeatable thing. So what is it really? Well, the entire theory is built on looking at what the price did yesterday. That's it. By finding the highest and lowest points from the day before, the strategy says you can literally map out where the market's biggest players, the ones with the deep pockets, have drawn their lines in the sand. And the main tool you're going to use for this? It's almost ridiculously simple. It's not some fancy expensive indicator. It's not a complex algorithm. Nope. It's just a box that you draw yourself on the chart. They call it the manipulation box. And check out how easy this is to set up. First, you just flip your chart over to a daily view. Second, you literally just draw a rectangle connecting the absolute high and the absolute low of the previous day. And yeah, make sure you include the wicks, those little thin lines. And third, you just kind of eyeball a line right through the middle. That's it. Seriously, this simple box is now your entire playbook. Now, this is where that simple little box gets really, really interesting. It's not just one big area. You need to think of it as 3 distinct zones, and each one tells you something absolutely critical about where the power is in the market. The top part of that box, that's where the price got smacked down the day before, right? Well, according to this theory, that is the seller's fortress. Think of it as their home turf, and you can bet they're going to defend it. And what about that area in the middle? Well, that's described as just pure noise. It's chaos. It's a total tug of war between buyers and sellers, and nobody's really winning. The risk versus reward in here, it's just terrible. It's unpredictable. And just like the sellers have their turf up top, the bottom of the box, well, that's the buyer's power zone. This is where the price found its footing and bounced. It's the home of the strongest, best-funded buyers, and you better believe they're ready to protect it. So you've got the zones. What do you do with them? Well, with these 3 zones mapped out, the strategy gives us 3 incredibly simple rules to follow. And the whole game here is about discipline, not genius. Rule number 1, and this is a big one. When the price creeps up near the top of that box, you simply do not buy. The source uses this great analogy. Why on earth would you walk into the lion's den and try to pick a fight with the strongest seller? You're basically betting against the heavyweights, and that's a losing game almost every time. And you guessed it, rule number 2 is the exact opposite. When the price is hanging out near the bottom of the box, you don't sell. Why? Same reason. You're walking straight into the strongest buyer's territory, and the odds are just massively stacked against you. And finally, rule number 3. If the price is just floating around in that messy middle zone, you do nothing. You sit on your hands. You wait. Why? Because you have 0 edge. It's a 50-50 coin flip, and that's not trading. That's just gambling. And this is what it all boils down to, really. Look at these numbers. The whole strategy suggests that if you trade at the edges, the top or the bottom, you're playing a high probability game. We're talking like an 80% chance that the big players are going to step in and defend their turf. But in the middle, you're just guessing. So the really crucial point is this. It's not about being a psychic who's right 100% of the time. It's about consistently putting the probabilities in your favor. This approach is designed to force you to focus only on the best setups and to just completely ignore all the other noise. All right, enough theory. That all sounds good on paper, but let's see how this thing actually plays out on a real chart. We're going to walk through a couple of quick examples from the source material and put these rules to the test. Okay, pop quiz. The market opens up and the price is hovering right near the bottom of our manipulation box. You're looking for a trade. Based on the rules we just went over, what's the play? Do you buy or do you sell? If you said buy, you got it. Now, you might look at that last candle and think, looks kind of bearish, like it wants to go down. But the rules are the rules. You do not sell into the strongest buyer's home. You trade with them. And what happens? A little while later, the price respects that zone and pushes right up. Okay, round two. Let's fast forward a bit. The price has rallied all the way up, and now it's knocking on the door at the top of that exact same box. You're looking for a trade. What do you do now? Buy or sell? The correct trade here, according to the rules, is to sell. You're in the seller's debt now. And just like before, the price hits that area, gets rejected, and starts heading back down. See, it's this kind of boring discipline that keeps you out of those gut-wrenching emotional traps that make so many traders lose their shirts. So let's just recap the core ideas here, because they're super simple. You always sell with the big sellers at the top, you always buy with the big buyers at the bottom, and you stay the heck out of that confusing garbage in the middle. This simple box isn't just about finding good trades, it's about actively avoiding the bad ones. And this really gets to the heart of the whole thing. Success in trading isn't about finding some perfect, magical system that never ever loses. It's about understanding the most likely outcome in a situation and just consistently, patiently betting on that probability over and over and over again. And so that leaves us with this final thought to chew on. In a world that always seems to think that more complex equals more effective, this whole theory asks a really powerful question. Are you really looking for a more complicated indicator, or are you just looking for a more disciplined way to follow a simple idea? The answer to that could honestly change everything about the way you trade.